If you are starting late, you do not have the time for trial and error. Every wrong move costs you years that you don't have. You cannot afford to reset every year. I followed trends, chased hype, did investing in the wrong order, and that mistake cost me years and the little money that I had. I know this mistake too well because I started very late when it comes to finances. My first job was at 35 years old, making $30,000 a year because I had no prior job experience. I honestly thought investing was for the rich people who understood the stock market. So I did what most beginners do. I chased crypto, penny stocks, and whatever YouTube said was the next big thing. I fumbled the first 2 years so badly that I lost everything. But 4 years later, I built a multi-seven-figure net worth, not from luck or hype, but from simple understanding of how money system works in America. And if I could get to financial stability starting so late in my late 30s, a very normal person with no finance degree, an immigrant who came here as an adult and didn't understand how the money system works in America, if I can do it, you can do it faster and better. Because in this video, I'm going to guide you step by step and hold your hand through it. I will show you exactly what you need to know about money in America as a beginner, how to invest, how to protect your money, and how to come out ahead long term without guessing or gambling or the hustle culture. So let's dive in. Part 1. Why investing matters. Let me start with the foundation. What does investing mean and why should you care? Investing is when you put your money to work so it grows over time. It's as simple as that. Now, why does that matter to you? Number one, your money is losing value right now wherever it's sitting in a checking account because every year inflation drives prices higher. The $1,000 you have sitting in your account today will not buy the same amount of groceries in the next 2 years. It feels safe to do nothing and just have your money sitting in there, but you're actually watching your purchasing power shrink. Number two, our economy rewards people who own things, businesses, real estate, assets. Think about it. Someone who bought a property 2 decades ago has probably watched it double or triple in value. He is rewarded for investing that money. Someone who puts money in the market has averaged 8 to 10% annual returns. Meanwhile, most salaries have stayed flat when you account for inflation. If you are tired of the cycle, work, pay bills, never getting ahead, this is the way out. You need your money generating more money while you sleep. Now, I know what some of you are thinking right now. I'm 45, I'm 50, I'm 55. Is it too late for me? No. Starting at 45 with consistent investing can build a $500,000 portfolio by retirement. The key is starting now and being aggressive with your contribution. Time matters more than timing, but contribution amount matters when you have less time. I started investing at 35 and I went very aggressive with it, and I have been able to build something very sustainable. So if you're starting later, you want to aim for 30% of your income instead of 10%. The stock market sounds complicated, but it's actually pretty straightforward. Let me break it down to you. When you purchase a stock, you're becoming a part owner of that business. You buy Apple stock, you now own a slice of Apple company. You're essentially betting that this company will continue to grow and generate more profit. So you make money 2 ways. First, price appreciation. For example, you buy $100 per share and years later it climbs to $150. You sell and you pocket that $50 difference. And that is what is called capital gains. Second way is what is called dividend payment. Certain companies distribute a portion of their earnings, of their profit, to shareholders regularly, sometimes quarterly or annually. It is their way of rewarding you for trusting them with your money. Here is where most beginners make their first mistake. They think, great, I will buy Netflix or Apple and watch it grow. But here is the problem and the mistake that I made. Even massive dominant companies can collapse or stagnate. Let me give you a real example. BlackBerry. In June 2008, one share was $144, but today that same share is worth $4.52. Everyone in 2008 thought BlackBerry owned the future of mobile phones. That company felt untouchable. Then smartphones evolved and BlackBerry couldn't keep up with the evolution. The point is, Predicting which company will thrive decades from today is nearly impossible. So what smart investors do, they stop guessing, and instead of buying one thing, they buy the whole bucket through index funds. Index funds are a bucket stocks bundled together to mirror an entire market segment. For example, the S&P 500, it's a fund that holds the 500 biggest US companies: Apple, Microsoft, Amazon, Tesla, Google, hundreds more. If you had put only $100 into S&P fund in January 1996 and then you reinvest the dividend, today you would have about $1,700. Instead of gambling on one company, you're spreading the risk across hundreds of companies. Some will underperform and others will do really well. Regardless of what happens, you are riding the market upward. Over decades, you hold pieces of every major sector in technology, in healthcare, energy, financial services. But you might be wondering, why not just buy the top performers? Right now, everyone is talking about the Magnificent Seven, which is Apple, Microsoft, Amazon, Google, Tesla, Nvidia, and Meta. They have driven market gains for years. So why not just load up on these big ones? So here is what most people don't talk about. Market leaders shift constantly. Look at S&P 500 between 1980 and 2020. Completely different names dominated. General Electric, ExxonMobil, Walmart. Go back to 1960s and the 70s. The giants were McDonald's, Kodak, Coca-Cola, American Express. Everyone assumed these companies would reign forever. Then the 1970s bubble popped and stock prices plummeted. Kodak dropped over 90%. Fast forward to December 2025, we're watching it happen again with AI stocks. Tech shares are selling off. Investors are nervous we're in another bubble. No one knows which company will dominate in 2035. That's exactly why you don't bet on individual winners. You want to own a portion of everything. Diversify across companies, industries, and even countries. This approach reduces risk and builds stability for long haul. Now, some of you might be wondering, what about dividend investing or REIT? This can be part of your strategy, not completely all of it, especially if you're closer to retirement and you want income now. But for most beginners, start with broad index funds first. Once you understand the basics and have a solid foundation, you can now add dividend stocks and real estate investment. Before you invest anything, you need to have your 3 to 6 months emergency fund, essential expenses. Save it in a high yielding savings account. Don't do any investment until you have this. If you have an inconsistent income, let's say you are a freelancer or you're a business owner, you want to go for even 12 months. Because if you lose your job or you have an emergency, you don't want to sell off your investment at a loss just to survive. Your emergency fund protects your investment. It gives you breathing room so you're not forced to cash out when the market is down. Once you have this cushion, then you can start investing. Do not skip this step. I help a lot of women set up their finances correctly, and I see too many people jump straight into investing. Then they panic and pull everything out when an emergency hits. Build the foundation first. Here is your action plan. Step 1. Choose a brokerage platform. This is where you actually buy your investment. I currently use Fidelity and I've used it for about 5 years now. Look for 3 things: proper regulation, solid reputation, and low fees. You don't want to spend all your money in management fees. Before opening an account, check what account types they support. Here is your priority order. First, if your employer offers a 401k with a matching contribution, start there. That's free money right there. If they match 5%, contribute at least 5% to get that full match. Next, open a Roth IRA or traditional IRA. Roth means that you pay taxes now, but your money grows tax-free forever. It is best for younger earners or moderate. So traditional gives you a tax deduction now, but you pay taxes later. This is best for high earners. Max out this account first before investing in taxable account. Why? Because taxes will eat 20 to 30% of your gains in taxable account. In tax advantage account, you keep 100% of your growth, like the Roth IRA. Step 2, fund your account. Transfer money from your bank. Most platforms make this easy, like Fidelity. I just link my account and I can automate money to go in there every payday. Start with whatever amount feels comfortable. Now, if you have money sitting in your checking account right now, $5,000, $10,000, $50,000, and you have been frozen by indecision, here is what I would do. I would not dump all of it in at once. I would spread it across 6 to 12 months so you can now dollar average in. Set up automatic transfer to move a portion every month. That way you're not timing the market, you are averaging in. And if you don't have money to invest yet, you just go ahead and watch and you learn and you get yourself ready, because knowledge comes first, then money comes later. When you are ready, you know exactly what to do. Step 3. Select your investment. Remember earlier when I explained index fund, you start right there. Choose something that is broad, S&P 500 index fund or total US market fund. Resist the urge to pick individual stock at first. I had to learn a very expensive mistake. Step 4, set up automatic investing. That's what I do. This is where most people mess up. They try to time the market and then they fail. Instead, schedule automatic monthly contributions. This approach is called dollar cost averaging. You buy regardless whether the prices are high or low every month. Over time, your purchase prices would average out. More importantly, automation removes emotions from that equation. You cannot panic and stop investing when the headlines get scary. Here is what everybody worries about. What happens when the market drops? What if the market collapses and I lose everything? First, understand this. If you are holding diversified index funds, you've already built in protection. Your portfolio contains hundreds of companies across multiple industries. When some struggles, others thrive. The whole system doesn't collapse simultaneously. This is precisely why diversification matters so much. But let me tell you the real danger. It's not market crashes. It is you. The market dips, the headlines scream about doom, some talking headlines predict disaster. You panic and you sell everything at a loss. Then the expert was wrong. Markets recover and climb higher. This happens every time. But now you're stuck. Either you sold at a profit but missed additional gains, or worse, you sold at a loss and locked in the loss permanently. Buying back in now costs you more. This is exactly why automation saves you. When you invest automatically every month, you cannot panic and sell during temporary drops. You can't obsess over finding the perfect entry point, the perfect time. It really doesn't exist. So the best time to start investing was a decade ago. Second best time is today. The market goes down sometimes. That's very normal. In 2020, the market dropped 34% in 1 month during COVID. In 2008, it dropped 57%. Very scary, right? But here is what history shows us. Every single time the market has crashed in the last 100 years, it has recovered and gone higher. Every single time. The S&P 500 has never had a negative return over any 20-year period. Never. So if you stay invested through the dips and keep contributing, you come out ahead. The people who lost money, they panicked and sold at the bottom. They bought high and they sold at the bottom. Don't be that person. When the market crashes, you're not losing money. You are buying stocks on sale. We love to buy on discount. Now, let me show you the mistakes that cost beginners thousands. I was here also. Mistake number 1, waiting for ideal conditions. There is no such thing as perfect market timing. In 2025, market hit records and people say, I'll wait for the crash. The market kept climbing. Others waited during 2020 pandemic crash, too scared to buy. Then everything recovered and soared even higher. So stop waiting and start today. Mistake number 2, attempting to time the market. No one can consistently predict daily or weekly prices movements. Not even Wall Street can do this. Not even professionals with armies of analysts can do this. This is why you automate monthly investment regardless of what the market does. Mistake number 3, concentrating everything on one stock. I see this constantly when I'm working with women. Someone buys Tesla or Nvidia because it's performing really well very recently, but it drops 20% and they freak out and pull their money out. Spread your money across hundreds of companies through index funds. Mistake number 4, thinking you need 1,000 or thousands of dollars to start. You don't. You can begin with $50 or $100, whatever you can afford right now. The goal is to create the habit of consistency, because consistency matters more than the initial amount. Mistake number 5, obsessively checking your account. It's like planting a seed and you keep digging it to see if it's growing. This adds unnecessary stress to you because the market fluctuates daily and it's very normal. So zoom out your perspective and think in decades, not days. If you're investing for retirement, 30 years away, this week's dip means absolutely nothing. Mistake number 6, not paying off high interest debt first. If you have credit card debt at 20%, 10%, 15%, you should pay that off before investing, because you're not going to consistently earn 20% in the market to make up for the money you're losing in that high interest credit card. And if you are concerned because you're starting late, like I said, I started very late, but I invested a lot. You can start with 25 to 30% of your income. I go as far as 60% of my income to invest because I started late. I need to make up for all that delayed time that I had. What if the market crashes right after I invest? You keep investing. Crashes are buying opportunities. We love to buy good things on discount. Every crash in history has always recovered as long as you are in this bucket called index fund. So here's exactly what I did to go from $30,000 at age 35 to 7 figures in 6 years. I saved 6 months of emergency fund in high yielding savings account, paid off high interest debt, and then I automated every month. About 30% of my income went directly into an investment account. And as I made more income, I just kept putting more and more and more in there, up to 60, 70% in some months. That money disappeared automatically. I couldn't even impulse spend it. You have to protect yourself from yourself. Secondly, I invested broadly. I didn't try to find the next big winner. After learning a lesson of where I lost a lot of money, I was not playing that games anymore. I just went broad market index fund. I completely ignored market timing. I invested the same amount every single month, whether the market was soaring, crashing, or flat. Number 4, and I left it completely alone. I didn't check daily because I don't want to panic during downturns. I let compound growth do its work, and that is the entire system. But here is what most people miss. Building wealth doesn't require financial expertise. You don't have to have this financial background. It's just you having a reliable system, a system that you follow consistently, ignoring whatever panic the media is selling today. Because trust me, the headlines will always manufacture fear. That's how they make their money, by creating fear. Recession is coming, unemployment is rising, market collapse ahead. You just tune out and follow your system. But the hardest part is just starting. Most people watch the videos like this, they feel inspired, and they do nothing. I started way too late. I didn't have time to play around or for excuses. People wait for the right time, they overthink it, they get scared, and 3 years pass and they're still in the exact same place. Imperfect action will always beat perfect planning every single time. You don't need to understand everything before you start. You learn by doing. I didn't know anything when I started at 35. I made a lot of mistakes and I fumbled the first 2 years, but I learned as I went. That's why I'm offering a free coaching call, something I wish someone had given to me, because it would have saved me time and a lot of money. On that call, we'll come up with a customized plan built around your specific income, age, your family situation, and your financial goals. Maybe you're 45 years and starting late. You need a different strategy than someone who's 25. Maybe you have $40,000 sitting in your account right now and you're paralyzed by indecision. Maybe you're dealing with debt and don't know whether to pay it off first or start investing. I'm offering this free coaching course and it fills up very fast because it's free. The link is in the description. Thank you so much for watching. Thank you for subscribing, and see you in the next video.